stocks are headed for losses at the open after that major sell-off in Japan. For more on the markets, we are joined this morning by the UBS Global Equity Strategist, Jeff Palma. Jeff, good to have you with us. Dom.
I could be John.
Dom and Sheila here with me, too. Jeff, on Friday, I think I heard you say that, this earthquake in Japan is not going to have a major impact on the global markets. But today, do you feel any different?
Well, I think the point here is that Japan's earthquake isn't necessarily one that's going to impact the global economy in a very big way right away, but certainly impacts on the markets are pretty clear, right? There's a heightened sense of risk aversion. There's certainly disruptions. There's massive disruptions to large parts of Japan.
Right.
And so there are going to be some associated impacts, but this isn't one that has, I think, an immediate fallout for the global economy, at least in the very short run.
So, Jeff, it's Sheila Dharmarajan here. Investor sentiment hugely rattled by all the events of the past couple of weeks. Where are you telling investors to put their money? I mean, you look to energy stocks, very, very volatile. You look to tech stocks, a lot of questions now after Japan. Where is the place to go?
Well, I think very clearly here, not only from a geopolitical standpoint are we being influenced, but we're also being influenced by a maturing process in the business cycle. And so this process by which cyclical sectors have massively outperformed is likely to moderate. So we are recommending a bit of a balanced portfolio at the moment. So the sectors that we like are basic materials, energy, and healthcare. And regionally, we like emerging markets still. We also like, to some degree, the U.S. as well.
Hey, Jeff, it's Dominic here. Does that cyclicality coincide perhaps with the breakdown that we perhaps are seeing in the S&P 500? A lot's been made about these trend lines. Market technicians, chart watchers out there saying that we could be seeing things break down. Is now the time that we could see a turn in the markets?
Well, we've certainly seen some moderation of growth numbers. We think that earnings growth is going to continue to moderate. Our risk appetite index has fallen quite sharply over the course of the last couple of weeks. All those things, I think, are combining to put a little pressure on the market. And we're seeing a little bit of pressure, of course, in those cyclical sectors. To the extent that they've been the drivers of markets, we're going to need to see a bit of an offset to stabilize the market around these levels if that's going to happen. But given the rally that we've had, there is certainly more vulnerability to shock, and there's more vulnerability just to a garden variety pullback.
And more vulnerability, Jeff, than to a market correction, a bigger correction than what we saw in the last few weeks?
Well, I think so. I mean, we've barely seen a correction in the markets over the course of the last 6 months. This rally since the middle of August has really been uninterrupted. And so, yes, I think we still need to see things go right. Now, the good news is fundamentally, we're still quite positive about growth. We think corporate balance sheets are in good health. But clearly, given everything that's going on in energy prices in Japan and the Middle East, there's definitely still vulnerability here.
Hey, Jeff, your colleague Jonathan Golub over there has been talking about the two E's out there, earnings and the economic news that have been kind of powering things forward. Is there anything else that can power it forward besides just good earnings, which are pretty much done with, or the economic news that we've already seen?
Well, from my standpoint, it's more now the economy. We need to see a sustainable growth recovery support valuations, because my view is that earnings growth is slowing pretty sharply around the world. We think that profit margins are peaking out. As that happens, more has to come from valuations. The way we get valuations higher is to see a sustainable economic recovery. And I'd say the one other element here is the use of the corporate balance sheet in a more shareholder-friendly way.
Right.
Giving back some of that cash to shareholders or using it better to support growth and return on equity would support valuations.
Right, buybacks and dividends. Jeff, just real quickly, I want to pick up again on that vulnerability that you mentioned. Tom Lee told us on Friday he's still looking for a 7 to 8% market correction. What are you looking for?
Well, I mean, look, the way I think about things is looking ahead as far as the supports are concerned. Could we see a bit more pullback given risk aversion, all those things? Of course we could. Again, we've kind of come through this rally very much uninterrupted, and so it would certainly be wrong to suggest that the markets couldn't stabilize, pull back, consolidate, however you want to think about things. Okay. We still think for the U.S. that you can trade north of 1,400 by the end of the year, 1,425.
Jeff, thank you. Good to see you. Jeff Palma of UBS.